Today, in under 20 minutes, I will provide you what you need to know if you want to invest in Amazon. Trading near $232 per share, I currently have a buy rating on Amazon stock, but there are several key factors that have a major impact on this thesis that I'll go deeper on. I will give you the positives and negatives from the 3Q'25 results, a breakdown of the three financial statements on my Wall Street valuation model, what other analysts on Wall Street say about Amazon, and my conclusion on Amazon's future and what you should do. So why should you listen to me? My name is Ken Freeman. I'm a CFA charter holder. I also am a professor of finance and economics. I have 20 years of Wall Street experience, and I'm the guy that investment banks like JP Morgan and asset managers like BlackRock hire to train their financial analysts on Wall Street. In my research, I discovered 6 things that got me very excited and 5 red flags to watch out for with Amazon. If you're enjoying this, please smash that like button. In 3Q'25, Amazon beat Wall Street expectations on revenues and EPS, and AWS and advertising beat too, which caused shares to jump. Let's cover the red flags first. Amazon had to pay billions to settle an FTC case. Anytime a company pays this much to regulators, it signals a deeper problem in how it operates.
Operating income was $17.4 billion, but would have been over $21 billion if not for 2 special Q3 expenses. $2.5 billion for an FTC settlement and $1.8 billion for estimated severance costs.
Amazon spent over $50 billion more than last year on property, plant, and equipment, causing its free cash flow to fall sharply. Amazon is burning through cash to keep up with AI demand. This pace is not sustainable long term.
Must be nice to just burn cash.
Amazon straight up warns that its tech and data center costs are climbing fast. Rising costs plus shrinking cash equals pressure that even a giant can't ignore.
Since 2022, Amazon has already cut more than 27,000 jobs, and it's now on pace to spend more than $120 billion just this year on CapEx to compete in those cloud wars.
Amazon wants 1.3 gigawatts for new AI data centers. That's nuclear reactor scale, meaning big strain, big costs, and big risk.
Nuclear power plants.
Amazon spent up to $2 billion cutting jobs, a sign that it's shrinking parts of its business to control costs. Huge severance bills are the price that Amazon has to pay today to have robots running their fulfillment in the future.
Now, the company is cutting 14,000 white-collar jobs, or about 4% of its corporate workforce, with layoffs hitting teams across the business. Employees in its video games, grocery, HR, comms, ads, and devices units were informed of cuts early this morning, but layoffs are expected to touch nearly every area of the business. Amazon's HR chief also suggesting in a blog post this morning that more job cuts are coming through 2026. And if the total hits 30,000, as Reuters reports, this would be the largest corporate layoff in Amazon's history.
Here's what got me really excited. AWS is back to fast growth after years of deceleration. AWS is Amazon's profit engine. When it accelerates, the whole company strengthens.
AWS is growing at a pace we haven't seen since 2022, re-accelerating to 20.2% year over year, our largest growth rate in 11 quarters.
Profit jumped even after absorbing layoffs, a huge FTC settlement, and depreciation shifts. A business that grows earnings under heavy stress is demonstrating real strength.
You look strong.
Amazon paired robotics with a delivery station to increase speed. Faster delivery strengthens customer loyalty and keeps Amazon's service advantage.
Companies are updating their tech, of course, and that includes Amazon, which says it's actually launched a new AI foundation model and deployed its 1 millionth robot to support faster delivery times and lower costs.
International swung from a loss to a strong profit. A segment that used to drag on results now adds fuel to earnings. Amazon is spending $15 billion to build a huge new AI compute campus in Indiana. It signals long-term confidence, bigger AWS capacity, and stronger AI positioning.
Amazon investing another $15 billion into northern Indiana to build an AI data center campus. Now, this will serve multiple customers, and a source tells me it's not directly tied to that new OpenAI contract. But what we do know is that the project adds 2.4 gigawatts of capacity, enough to power 1.8 million homes, and it comes on top of that $11 billion Anthropic campus already underway in the area. Since 2010, Amazon has invested more than $31 billion into the state. And a big piece of this is energy. Indiana is rapidly becoming an AI infrastructure hub thanks to an abundance of nuclear and coal power, plus generous local incentives.
This is what everyone is missing. Amazon has beaten expectations on both sales and profits for 4 straight quarters. When a company keeps doing better than expected, it shows consistency and strength. When it comes to any stock, I let the numbers tell the story, and that involves looking at a company's financial statements. Would you buy a house without knowing the size, location, dimensions, or condition? That is exactly what you're doing when you buy a stock without understanding the three financial statements. If you want to see how I teach the world's top financial analysts on Wall Street, check out my school community, Win Like Wall Street. Just scan the QR code on the screen. The balance sheet shows us how the business is funded. If assets grow faster than liabilities, equity increases, and we win. At year end, Amazon has almost $79 billion of cash, and if we combine the cash invested in securities, it's over $101 billion. At the end of 3Q, it's still an impressive $94.2 billion, and they are currently net cash, which means cash is greater than debt by over $43 billion. Imagine if every dollar of debt that you had, you were sitting on more than $2 of cash. That is Amazon. This gives the company a stockpile of cash to invest in the future, including AI infrastructure, warehouse robotics, delivery optimization, and their rapidly growing cloud business. Retained earnings increased over 50% in 2024 and through 2025. Other than Tesla, Amazon is the only other Mag 7 company that does not pay a dividend, which boosts retained earnings. Part of Amazon's secret sauce, going back to the Jeff Bezos days, is to plow as much capital as possible back into the business. All right, here comes the gold nuggets. While marketable securities doesn't stand out, that is where Amazon's $4.8 billion investment in Rivian is. They own 18% of the company. Amazon has invested heavily in Anthropic, the company behind Claude, which is a competitor to ChatGPT. $14.8 billion of preferred stock, $23.7 billion of convertible notes. This is a total investment now worth $38.5 billion, and it's captured in other assets. It pays to read the notes to the financials if you know where and how to look. So what's the takeaway? Amazon has tons of cash, its debt is declining and manageable, and despite heavy CapEx, it is massively growing retained earnings. The income statement shows us if a company is generating profits. We want to see revenues grow faster than expenses, which will grow profits. The way we determine how effective a company is at generating profits is via margin. Revenues minus expenses equals income, income over revenues equals margin. If a company has higher revenues and lower expenses, it will have higher margins. If revenues grow faster than expenses, margins will get bigger or expand, which is what we want to see. Last year, Amazon generated a massive $638 billion in revenue, with 42% coming from online and physical stores. As of 3Q'25, advertising and AWS make up over 28% of total revenues, and that share continues to grow. Revenue grew 11% in 2024, which is remarkable for a company with over $600 billion in revenues, and it has been growing over 13% year over year over the last 2 quarters. Growth hasn't been that high in 4 years. Margins expanded across the board, which is a tremendous positive, showing operating efficiency even with high revenue growth. Gross margin is almost 51%, and operating margin is more than 4x what it was in 2022. Net margin has also expanded massively. This shows that the company is efficiently managing costs, which is a great sign for investors. While net income fell in 2022 due to a one-time write-off of Rivian, see other, it grew almost 95% in 2024. Amazon is growing revenues faster than expenses, which means more money falls to the bottom, and this is a great sign for investors. So what's the takeaway? Over the last 5 years, net income has grown more than double the rate of revenues. This is a win-win for investors and shows incredible operating leverage and cost efficiency at Amazon. The cash flow statement tells us where the cash is generated by the company, and there are 3 buckets. Operating, which is the cash the company generates internally. Investing, which is the cash demanded for long-term growth. Financing, which is the cash the company generates externally. When we add these together, we get the net change in cash. We want to see companies generating cash making this positive, not losing cash, which would make this negative. Operating cash flow is positive and growing rapidly. The increase in operating cash flow is driven primarily by the strong net income that Amazon is generating. As I mentioned earlier, Amazon is the only Mag 7 company other than Tesla to not pay a dividend, but they did return $6 billion to shareholders in 2022, and they have $6.1 billion remaining under the current share repurchase program. Jeff Bezos became known for reinvesting back into Amazon to grow the company, and Andy Jassy has carried the torch. This is the secret behind how Amazon has become one of the most valuable companies on earth. Free cash flow has been declining every quarter over the last year. This is due to the fact that growth in CapEx has been outpacing growth in operating cash flow. Since free cash flow is the basis for our valuation, investors will want to see this start moving the other way to prove that AI investments are bearing fruit. So what's the takeaway? While Amazon is generating growing operating cash flow, they need to ensure that CapEx growth does not crush free cash flow for too long, or else it will start hitting the valuation. So, what do I think about Amazon? What should you do? I'll get into that, but first, let's go through my valuation. On Wall Street, we build a discounted cash flow model to measure the intrinsic value of companies. Because companies generate cash flow and we projected the three financial statements, we could take these future cash flows, discount them back to today to get a current intrinsic value for the company. We cannot do this type of valuation with crypto, baseball cards, or art because they have no cash flows. As you can see on the left, we take specific line items that we projected from the three financial statements. We use these line items to calculate free cash flow to the firm, or FCFF. To this, we add a terminal value, which is the value from the end of the model out to infinity, because the company does not stop operating when our model ends in 5 years. We discount these cash flows back to today to get to total enterprise value. To get to equity value, we strip out the debt, we add the cash, we strip out non-controlling interest, we add associate investments. We get an intrinsic equity value of $3.09 trillion. We divide by the current shares outstanding, we get an implied share price of almost $289 compared to the current price of $232.38. That's a 24.3% discount, which is a buy rating. On Wall Street, if a stock is trading at greater than a 20% discount, it's considered a buy because it provides us a margin of safety. Stick around because I'll give you my thoughts on how to play Amazon later in the video. Also, feel free to come to my live stream every Monday at 7 p.m. Eastern Time, where I'll answer your questions on this video or anything else. The link is in the description. So what does Wall Street have to say about Amazon? Let's cover that next. Analysts overwhelmingly maintain a strong buy on Amazon. Stifel has a buy rating and it raised its price target to $295 from $269. Stifel points to AWS acceleration to 20% growth and Q3 revenue ahead of expectations, reinforcing strong enterprise demand. Also, they mention Amazon's outperformance versus Microsoft's Azure and Google's cloud platform in quarter-over-quarter acceleration. Oppenheimer has an outperform rating on Amazon and they raised their price target to $305 from $290. They see AWS expansion, including Project Rainier activation, driving multi-year cloud revenue acceleration. They also note that each incremental gigawatt of AWS capacity could yield approximately $3 billion in revenue, positioning Amazon for meaningful upside. Cantor Fitzgerald has an overweight rating on Amazon, and it raised its price target to $315 from $280. Cantor noted 3Q results that beat expectations and Q4 guidance coming in above prior street estimates. Additionally, Cantor highlighted continued improvement in profitability metrics that reinforce confidence in Amazon's execution. CapIQ gives me a sense of how other analysts on Wall Street view the company. 59 analysts cover Amazon on Wall Street. The range is from a low of 245, which is a 5% increase, to a high of 360, which is a 55% increase. The median is 300, which is a 29% increase. The overall rating on a scale of 1 to 5 is 1.33, which is a buy rating.
You should seek the advice of an investment professional always. I do not know your individual financial situation. This content is meant to educate and is not investment advice.
That being said, I do own a position in Amazon. It's currently 4.5% of my overall portfolio. I'm a big believer in the company, and I'm planning on building my position as a result of this analysis. If you decide to buy Amazon, I'll tell you exactly how to build a position, including the ideal entry point, which I'll reveal shortly. Predictions for Amazon's profits this year went up. A rising outlook means confidence in Amazon's long-term performance is growing. Amazon secured NVIDIA's elite interconnect technology for Trainium 4. This massively boosts AWS's AI horsepower and makes its homegrown chips far more competitive.
Here comes the Trainium. What can it do that's better than anything out there?
Yeah. So when customers think about all of the AI that they want to accomplish, a lot of this comes down to they want to make sure that it's cost effective, right? If you're going to spend massive amounts of money to go and transform your organization with AI, we've got to get the cost down. And so for us, it's at every layer of the stack, we're focused on how do we drive cost and increase capabilities. And Trainium is a huge way of doing that. Trainium 3 is the most capable chip that we've ever produced. It gives you 3x more capabilities, 4x more capabilities. It can actually produce 5 times the number of tokens per megawatt of power that we used to be able to compute, that we used to be able to produce. And given that power and data centers are one of the scarce resources today, being able to produce 5 times as many tokens is a huge leap forward. We're really excited about rolling out Trainium 3, and we think it's going to be transformative to what people are able to accomplish as these models get bigger and bigger.
Amazon won a major deal to power OpenAI's infrastructure with Ultra servers. It cements AWS as a core supplier for frontier AI and creates long-term high-value demand. Amazon hit a 52-week high of 258.60 in early November 2025, and it's down over 10% since then. The recent pullback after 3Q25 results brought the stock below 220, but it's on the rise and I don't think it will stay at this discount for much longer. My model shows a value of 289, which is a 24.3% discount at current levels. On Wall Street, we buy with a margin of safety of at least 20%. So Amazon is a buy at current levels, and anything below 240 will provide you with a 20% margin of safety. Amazon is a forever type holding that you buy and don't touch, and right now is a great entry point. I order from Amazon multiple times per week, and it's the only company I can say that I do business with consistently without fail. The low pricing, convenience, and simplicity make it an easy choice. If you like this and want to see another in-depth stock valuation, check out my meta video here or my SoundHound video here. And if you found this valuable, please share this with someone who you think would enjoy this. As always, be relentless.